Learning Goals. Welcome to this learning session on Wealth Protection Method. In this course, we shall address mastering wealth retention and banking, protecting real estate and assets, optimizing credit and debt management, tax efficiency, and estate planning, securing your generational legacy. There will be a quiz at the end to test your knowledge. The difference between earning and keeping. Many individuals spend their entire lives working hard and earning a significant income, yet they find themselves with very little to show for it in the end. This phenomenon occurs because the skill of making money is fundamentally different from the skill of keeping and protecting it. While earning requires labor and talent, keeping wealth requires a strategic understanding of financial systems and legal protections. Without these skills, wealth is often eroded by taxes, fees, and poor asset management. For many communities, particularly Black women, the pressure to provide for others can often lead to the depletion of personal savings before they can be invested. It is vital to recognize that building a legacy is not just about the size of your paycheck, but about the systems you put in place to ensure that money stays within your control. This course aims to bridge the gap between being a high earner and becoming a wealth builder who can pass down a foundation to the next generation. To combat this erosion, you should consider moving your emergency fund to a high-yield savings account at an online bank, which can offer rates between 4% and 5%. This simple shift can increase your annual earnings on $10,000 from a mere $10 to $500. These accounts are still FDIC insured and easily accessible, making them a superior choice for wealth preservation. Being intentional about where your money lives is the first step in stopping the quiet drain on your assets. The hidden cost of bank fees beyond low interest rates. Many bank accounts are riddled with hidden fees that quietly drain your wealth over time. These include monthly maintenance fees, minimum balance penalties, and out-of-network ATM charges that the average consumer rarely tracks. Statistics show that the average American pays between $150 and $200 annually in these avoidable costs. Over a decade, this adds up to thousands of dollars that could have been invested or saved for future needs. Monthly maintenance fees for basic checking. Minimum balance fees if your account drops below a threshold. Overdraft fees which can exceed $30 per occurrence. Paper statement fees for physical mailings. You have the right to call your bank and request a full list of every fee associated with your account. Often, banks will waive these fees if you meet certain criteria, such as setting up direct deposit or maintaining a specific balance. By asking for a fee-free checking option, you signal to the institution that you are an informed customer who is actively monitoring their financial health. Protecting your real estate assets. For many families, the home is the single largest asset they will ever own. Yet its legal protection is often overlooked. Many couples assume that because they bought a house together, they both automatically own it, but the law only recognizes the names on the deed. If a spouse dies and their name is the only one on the title, the survivor may face years of legal battles and thousands in probate fees. This is a preventable tragedy that requires immediate attention to the legal documentation of your property. There are two primary ways to hold title jointly: joint tenancy with right of survivorship and tenancy in common. Joint tenancy is generally preferred for married couples because it allows the property to pass automatically to the survivor without the need for probate court. Tenancy in common, however, means each person owns a separate share that is distributed according to their individual will. Understanding these distinctions is crucial for ensuring that your home remains a secure asset for your family. A will is not always the final word on asset distribution. Understand how asset titling and beneficiary designations can override your will and protect your wealth. A common misconception is that a will is the final word on how all assets are distributed. In reality, a will does not automatically override how an asset is titled. Real property transfers based on the deed. This means the deed's ownership structure dictates who inherits the property, regardless of what the will states. Retirement accounts and life insurance policies transfer based on the beneficiary designings filed with the provider. These designings filed with the provider These disannexins are separate from your will and take precedence. If these documents are not synchronized, your assets may end up in the hands of an unintended recipient, such as an ex-spouse. To ensure your wishes are honored, you must perform a comprehensive review of all your financial accounts and legal titles. This includes checking every retirement fund, life insurance policy, and bank account to confirm that the beneficiaries are current. Adding a payable on death, POD, or transfer on death, TOD, or transfer on death, TOD designation to your bank accounts is a simple way to keep those funds out of probate. These small administrative tasks are the actual mechanics of wealth protection, ensuring your assets are distributed according to your intentions. Closing the family ATM, being the financially successful member of a family, often comes with a heavy emotional and financial burden known as the family ATM syndrome. This is natural to want to help loved ones who are struggling, but providing indefinite support can prevent you from ever securing your own financial future. There is a critical distinction between helping someone up during a crisis and holding someone up as their permanent financial flaw. The latter often leads to resentment and the eventual depletion of your own retirement savings. Implementing a family-giving framework allows you to be generous without being self-destructive. This involves setting a specific annual budget for family assistance that is decided in advance, away from the emotional pressure of a specific request. Once that budget is exhausted, the answer to further requests must be no. Regardless of your bank balance, protecting your own retirement contributions must be non-negotiable, as you cannot borrow for your retirement in the same way others might borrow for a short-term crisis. Credit score versus wealth score. In modern culture, the credit score is often mistaken for a measure of true financial health, but it only measures one thing: your reliability in paying back debt. You can have a perfect 800 credit score and still have zero net worth if you own no assets and have no savings. Conversely, a person with an average credit score who owns their home outright and has a robust retirement account is far wealthier. It is essential to stop obsessing over credit and start focusing on the numbers that actually define your wealth. The three numbers that truly matter are your net worth, your savings rate, and your retirement projection. Net worth is the total value of everything you own minus everything you owe. This is the ultimate scorecard for your financial progress. Your savings rate, the percentage of income you save and invest each month, is the engine that drives that growth. Finally, your retirement projection tells you if your current habits will sustain you when you are no longer working. These are the metrics of a builder. The high cost of credit card debt. Credit cards can be useful tools for rewards and convenience, but they are also one of the most expensive ways to borrow money. With average interest rates hovering between 20% and 28%, carrying a balance can quickly spiral out of control. For example, a $5,000 balance at 24% interest with only minimum payments would take over 20 years to pay off and cost over $8,000 in interest alone. This is wealth that is being transferred from your future self to the credit card company. The rule for credit card use is simple. If you cannot pay the balance in full every month, you cannot afford the purchase. Debt is essentially borrowing from your future self, and you must ensure that your future self can afford those payments without sacrificing their security. By paying off high-interest debt aggressively, you earn a guaranteed return equal to the interest rate you are paying. This is one of the most effective ways to immediately improve your financial standing. Preparing for the unthinkable widowhood is a stark financial reality that many women will face, yet few are adequately prepared for the transition. Statistics show that women outlive their husbands by an average of 5 to 7 years, and black women are often widowed even earlier. When a spouse dies, the surviving partner must navigate a complex web of financial decisions while in the acute stages of grief. Preparing for this storm, before it arrives, is an act of love for yourself and your family. In the first 30 days following a loss, your primary goal is to gather information rather than make major decisions. You need to locate all financial accounts, find life insurance policies, and obtain at least 10 certified copies of the death certificate. It is vital to avoid selling property or changing investments for at least 3 to 6 months, as grief can significantly impair financial judgment. Having a trusted estate attorney to guide you through the probate process can provide much-needed clarity during a difficult time. Maximizing your tax efficiency. Many people celebrate receiving a large tax refund, but a refund is actually an interest-free loan you gave to the government all year. If the average refund of $3,000 had been kept in a high-yield savings account, it could have earned over $100 in interest and been available for emergencies. The goal should be to own nothing and receive nothing at tax time, keeping your money in your own paycheck where it can work for you. You can achieve this by adjusting your withholding using the IRS W-4 form. Beyond withholding, many families miss out on legal deductions that can significantly reduce their tax liability. Charitable contributions, home office expenses for side businesses, and student loan interest are all commonly overlooked. Additionally, contributing to a traditional IRA or 401k allows you to invest pre-tax dollars, which lowers your taxable income immediately. For example, a $6,000 contribution for someone in the 22% tax bracket results in an instant tax saving of $1,322. Building the generational bridge. Generational wealth is often misunderstood as requiring millions of dollars or a complex trust fund, but its true essence is simply ensuring the next generation does not start from zero. It means your children can enter adulthood without the crushing weight of avoidable debt or the instability of renting forever. By leaving a foundation of owned property, life insurance, and financial knowledge, you provide your descendants with the freedom to take risks and build their own success. This is the ultimate goal of wealth protection. The most important asset you can pass down is not money itself, but the knowledge of how to manage it. Research shows that without financial education, even large inheritances are often spent within a few years. Start talking to your children about money early. Explain budgets, show them how you make intentional spending choices, and involve them in savings goals. When they see that a budget is a tool for freedom, rather than a punishment, they are equipped to carry your legacy forward. Your wealth protection checklist. Wealth protection is not a one-time event, but a series of consistent, intentional actions. To begin, you must calculate your current net worth to establish a starting point for growth. From there, review your bank accounts for fees. Confirm your property deed is titled correctly and ensure all beneficiary designations are up to date. These administrative tasks may not be romantic, but they are the essential paperwork that makes generational wealth a reality for your family. Research high-yield savings and move your emergency fund. Confirm your home deed says joint tenancy with right of survivorship. Update beneficiaries on all retirement and insurance policies. Create or update your will and write a letter of instruction. Set a family giving budget to protect your own retirement. Remember that your grandmother worked too hard for you to give it all back to a system that counts on your lack of knowledge. By taking these steps this month, you are honoring her struggle and securing a future that she could only dream of. You have the knowledge, the tools, and the right to protect what is yours. Start where you are, use what you have, and build from there. Summary: well done. You have completed the course Wealth Protection Method. You should now be familiar with mastering wealth retention and banking, protecting real estate and assets, optimizing credit and debt management, tax efficiency, and estate planning, securing your generational legacy. Should you need to revisit any of the topics in this course, please use the menu at the bottom of the screen.